going to be pushing very much today. I intend not wasting time, but starting immediately. Just to quickly get the admin things done. Please ensure that you complete the attendance for the class. And please ensure that you also complete the feedback form. I will also try to put on one before the end of the class. So quickly, just to reflect for a few minutes on the previous two classes, we started with the introduction to financial statements, introduction to companies. We spoke about shares, we spoke about dividends, we spoke about how a company is formed, types of companies. We've spoken about the most important document called Memorandum of Incorporation. We covered a lot. We also touched on the conceptual framework, which are two theories that are mostly included in your multiple choice. You'd have noted that we spent one class on those items. We broke down the theory, hoping that at least it does not become foreign when you are studying on your side. So I am hoping that you managed on your side to do your part, which is studying those two topics, specifically on Unit 1, doing the calculations around the dividends, knowing the different classification of shares, ordinary shares, other than ordinary shares, preference shares, knowing which kind of preference shares to look for, cumulative preference shares, redeemable preference shares, non-redeemable preference shares. A dividend, how is it paid if you are dealing with an ordinary dividend, ordinary share? It is declared and it is calculated in terms of cents as per the AGM, and then you have to multiply by the cents. You would be told that at the end of the year, the shareholders met and they have agreed that a dividend of 12 cents per share will be paid. And then all you have to do is to take the cents and multiply by the shares. When it comes to preference shares, preference shares have fixed dividend, which when you are given preference shares, you are always told by agreement or by contract legally how much percentage of dividends will be paid on preference dividends. We did a very important part of evaluating what we will be going through per standard throughout the year. So we did go over International Accounting Standard 1, which deals with the presentation of financial statements. We covered all the statements. We did a 2016 paper in a very short time, but we tried to learn so much in it. And please, if you were as confused as ever in that class, it just it's a gauge to see how far you are in terms of your accounting knowledge, and also a correct time to be picking up how much you should be investing in accounting in terms of hours and time. Accounting definitely requires you to practice a lot, and not just practicing, but understanding of principles in a proper context, not just for understanding. So today, we're moving on and we'll be working on inventory. So we'll be doing, I'm hoping, about 2 questions. There is a self-assessment question that is also on my UNISA. That's one of the questions that I want to do. The second question that we are going to be doing, it's question 3, which is on tutorial letter 102. But first, before doing these things, I do want to also inform you, one of the reasons for changing this class, why it will not be presented on Saturday. It's mainly because there will be a facet class presented by the lecturers, which will cover previous exams paper, June May-June 2020 exam. So definitely I would want you to attend that class for exam technique purposes, and also to have any questions that you have that you may pose them to the lecturers. And then there will be another one on the 17th again. So on the next class that we are going to be having, we'll have it on the 17th, same time, because FACET will be presented for the 12th and the 19th of September. I am hoping that you managed to do your assignment 1, and of course that you are busy now with your assignment 2. But with that, I do want to begin, and what I will do is I will work on a presentation that was also presented on the FACET class, and immediately after covering the presentation, we will straight go to the questions. So we'll just deal with the theory a bit, and then immediately go to the questions. So I will be sharing my screen, so you will not be seeing me. Please, if it happens that I do not see you, please feel free to just unmute yourself and talk to me, because I will not be seeing the screen that is on for me to see what is happening. I also just want to close a couple of things that I have opened me before we start today's class. Any questions? I had hoped that someone was going to say, here I am, I have a question, but it's fine. We'll move forward, but please know that I will be pinpointing anyone for an answer. This is meant to be an interactive session. It's honestly not meant to be one way only. When you are busy with FACET, it might be one way, but with tutorials, as a tutor, I expect to have some feedback session when I am deliberating and sharing anything on my side. So yes, let us proceed and see how we can complete this information. Sorry about that. I'm just trying to share. Just trying to share my screen. There we go. Managed to share. So we'll be working today and starting on inventory, and then so I'll quickly work on a presentation just to cover a few items of inventory, and then from a presentation we may begin. Right, this was of course a presentation that was done by one of the lecturers who was presenting at a FACET class, and I don't intend to take any material for this purpose. I want to use similar material because I don't want to reproduce what has been shared with students out there. So it helps for me as well on my side. So topic that we'll be presenting, of course, today will be inventory in terms of International Accounting Standard 2. And of course, many examples which are helpful to help you to understand different aspects of inventory are found on the textbook. That's why a study guide is referred to as study guide. And the most important reference made to is the textbook, which is considered as a prescribed text for you to use and to reference to. Inventory in general, it is an asset. We'll go to its definition and cover its definition at a later stage, but it's an asset that is disclosed on the statement of financial position. It is disclosed under current assets as inventory. In terms of the standard, it is measured at lower of cost on and or net realizable net NRV, net real this way it will come, but it's measured at lower of cost or NRV. It's also affect the statement of profit or loss and other comprehensive income when there are purchases in terms of inventory, you may use also to calculate the expense when you are purchasing inventory as cost of sales. Cost of sales may also be calculated in a manufacturing environment as finished goods, raw materials, work in progress. It can also be opening stock, purchases, and closing stock, but we will be covering this, I think, specifically when we are doing one of the questions that will be covering relating to, I think, Sonic Sport. Learning unit 4, most important thing for you to note is when inventory is bought and comes to the organization the first time, it is measured at cost and plus all other costs it takes to bring the inventory to its present location and condition as intended by management. So when you are purchasing inventory, it's cost price, which is the price that is invoiced, whatever you pay that is regarded as inventory. So if you are in the business of selling shoes, when you are buying the shoes, the quantity of the shoes that you are buying as identified on the invoice would be regarded as cost price, the cost that you have purchased the shoes as an example, and the transport cost to bring the goods to the location where you intend to resell those shoes. So it's the location and the condition. So the condition might be, you might take an insurance that should the shoes be stolen whilst in transit between where you are buying to the location where you intend to be selling. So the insurance and the transport costs would be one of the costs that would be capitalized. Capitalized means included in the value, in the valuation of inventory. So listen to this cost again. When you are purchasing inventory for the first time, it's measured at cost, and part of the costs that are included is also cost to bring the inventory to its present location condition as intended by management. So subsequent measurement, once you are holding inventory, it is measured at lower of cost or at net realizable value, lower, meaning that it's the lower between the cost and the net realizable value. So what is net realizable value? It is the selling price less the cost of completion or cost necessary to make the sale. But we're going to come back to this part again, where we're going to deal with NRV. Work in progress, it's about all costs that have been taken, undertaken or incurred by a company, an entity, to convert raw materials into finished goods. So if we're speaking in a factory setup, you are sitting with raw materials which needs to be converted into goods. So you are sitting with a manufacturing site where you are building cars. So you've got tires, you've got metals, windows, all the goods that make up a vehicle. So all of them, they come as raw materials. So all the costs that is incurred to convert the raw materials, parts of the cars to a car, would be your electricity that you use in the factory, would be the labor, and on all other costs, maybe spray, whatever it is that is used to convert the parts of the car into the finished good, which is a car. So we're going to be talking about that as well. So how is inventory measured? We have to determine the cost, and then we have to look at the company's policy in terms of the cost allocation. Is the company applying a first in, first out method? I'm sure you are aware now, first in. It's also used by retailers, especially food shops, food outlets, where they would ensure that items that are about to expire are put in the front shelf, and items that will expire last are put behind, so that you must also check it. Maybe tonight, tomorrow, when you are buying bread, you will see if bread is coming closer to the date of expiry, it will be put to the front, and the behind the shelf, you will be packing bread that is more fresh. This is called first in, first out method. You've got weighted average method, which looks at pricing over all items that have been received, no matter what time they've been received. First in, first out, what I spoke about was store management principles. But in terms of pricing, first in, first out means you are considering the prices when the items came in and when they came out. So your prices vary according to the timing of the goods. You've got specific identification, which relates to the specialized items. You've got standard costing, which relates to the management of inventory, or sorry, management of costing within the manufacturing setup. You've got retail, you've got NRV. So all these cost allocation techniques are covered in order to be able to measure inventory. We'll cover calculation of NRV, recording of inventory at lower of cost, and net realizable value at normal capacity. Very important, exercise 313. I'm going to cover this exercise as well. Exercise 313. It's one of the exercises that I also intend to quickly cover. Exercise 313, please know that we will cover this before doing the self-assessment question. This part of the slide gives you an overview of point A, B, and C. A, it's what happens when you are purchasing in terms of inventory. It's the cost prices I've indicated to you, the import duties, taxes, any cost, rebates, and discounts. So import duties, as you know, it's all costs that are taken to bring the assets to its location and condition. You've got conversion costs, we've already discussed them. But most importantly, everything that we have discussed in terms of work in progress conversion cost, it is classified under variable production overheads and fixed production overheads. So what is variable production overheads? It is the overheads that vary according to the number of units that are produced, and fixed overheads expenses that do not change as the level of production changes. So variable production overhead, it's costs that vary or change in relation to how much production is produced. So it depends on the level of produce. So for example, if you're dealing with things such as electricity, gas, water, equipment, utilities, materials, wages that you are paying to your labor. If you wages, not salaries, wages. So it is those guys that come in and out that have got short span contract. Those items that I've mentioned, electricity, gas, water, the usage depends on the level of production that you are producing. Whereas when you are dealing with fixed expenses, we are speaking about things such as rent. Rent, no matter whether you are producing or not, whether staff is refusing to work, it's over the weekend, they work, they don't work, rent does not change. Salaries, depreciation, and insurance also does not change. So no matter how much you are producing, fixed production remains constant. It's the same. It does not change as the level of production output changes. So conversion costs exclude abnormal spoilage. So what is abnormal spoilage? Abnormal spoilage, it's for example, if you are working in a fuel industry, and some fuel either evaporates or by chance it happens that it spills down, all those costs that are incurred in losing such units, losses, is not included in the conversion cost. So this also includes things such as idle time. It's not also included. It's part of the abnormal losses. So it's not included on inventory. So other costs, of course, that you consider in terms of inventory valuation, it's delivery costs, insurances that you may have had, as I made the example, design costs. And what is excluded in terms of inventory is selling costs, storage costs, and any interest that is paid. So all those things relating to inventory, they are excluded when you are determining the cost of inventory. So selling cost would not be regarded to be in the inventory or manufacturing setup, hence it is excluded. Those are the examples of allocation techniques. Inventory, as defined, is assets that are held for sale in the ordinary course of business. Inventory is expected to be consumed, is expected to be sold within 12 months. Hence, it is disclosed as a current asset. So please, I will share these slides as well on my notes. Go to this link. It will provide you excellent examples on cost allocation techniques. It will cover the production overhead costs and other costs as well in the manufacturing setup. So please try to go over this link. I am informed that the senior lecturer is the one that is presenting on this video, and they are explaining the techniques very well. So you are honestly encouraged to go through this. In summary, this summarizes everything that we have covered. That inventory are measured at lower of cost or net realizable value, and estimated selling price in the normal course of business less. So this is net realizable value. Each year there is a new assessment of net realizable value, and then in terms of the disclosure, you are told that the most important thing that you need to take cognizance of is the amount recognized as cost of sales, the carrying amount of inventory, amount of any write-down recognized as an expense, reversal of any subsequent write-downs in the previous financial period, amount of any inventories pledged as security. Very bold, it is not required to disclose the fact that carrying amount is at net realizable value. This is one of the examples that you are given of on the statement of financial position, how you disclose inventory under current assets, the cost of sales, then profit before tax. It gives you a remeasurement of consumables to net realizable value, and also the breakdown of inventory. There is a nice example as well that is given of Kelebogile. Under your MyUNISA, a solution is also shared on this. What I will be covering on my side is a self-assessment question. I will quickly share it with you. This is the question that I intend for us to cover. We will try to be extremely fast, but before that, sorry, I said that I wanted us to try and cover I said I wanted us to try and cover example 3.3. So this is in your textbook. If you do not have a textbook, please speak to someone who can be able to lend you, try to get it from the libraries. I know that the libraries are currently not functional, but it may be possible that online they can be able to provide you books. I'm not sure. And I'm not sure of the status of library at UNISA as well. But if there is someone who's got this textbook, try to speak to them as well. So this is example 3.3. And the main point is the application of cost formulas for perpetual and periodic inventories recording systems. So periodic inventory system is also defined, and perpetual inventory system has also its own definition. So I'm going to read, but I want someone who can tell us what is perpetual inventory system and what is also periodic inventory system. So we'll quickly try to read this question. So we'll always start with the actual, sorry, the required. So the required says you must determine the cost price of inventories using the FIFO and the weighted average method. ALTD include the following inventory transactions during the month of October 20.2. So here you are given the rent values, here you are given the units, you are given the dates as well. You are given opening balances, purchases, and then what you are given here, you are given the cost price of inventories. When you are using the FIFO method, you have to first see what is the inventories that have been on hand. So you say 200 plus 300 in terms of purchases plus 150. And then you deduct your sales according to the date. So you work according to the dates. And then you will see that you've got 180 units. So when you are determining the cost price in terms of inventory, it will be 150. So it's the 150 of the purchases. So one important thing that you have to do is you have to align the purchases with your sales. So the purchases opening balance was 200 on inventory, and then you sold 120 on the 2nd of October. On the 5th of October, you added another 300. So if you may follow this way that this calculation is provided. So you purchased 200 on the 5th, you had an opening, you had sales that were made of 120 on the 2nd of October. This was on the 1st of October opening. And then you had purchases of 300 on the 5th of October. and then you had sales of on the 15th of October of 200, and then you had purchases on the 20th of October of 150 units, and you also had sales of 150, which means that your closing units for the year, it's 180 units. This is the 180 here. And then the 150 is up until the period, the first period that relates to the 30 units that were purchased. So you'll see that the first 150 would have been on the closing stock. So which means that the 180 is spread across the last units that you purchased of the 5th of October and the last 150 units that you purchased on the 20th. So hence you use the prices in which the units were purchased on, and then you've got your value as 5,220. So comment, both the perpetual and the periodic inventory recording systems result in the same cost of inventories. So the question that I just want to ask you quickly is, what is the difference between perpetual and periodic inventory system? Anyone? Difference between perpetual and periodic inventory system?
Hello.
Hi.
Hi. Yes, the perpetual inventory system, that is recorded on a continuous basis, and the periodic system is recorded at the end of a period, like during a stock take, for example.
100%. That is basically a very nice example that you have provided, and thanks for providing a very clear and nice example. You may mute yourself again.
Thank you.
Thank you very much. So basically it is as she has provided, and thank you for the answer. Perpetual means continuous. So you are recording inventory as you are purchasing and selling. And periodic means you are only focused to evaluate your inventory closing balance at periods depending on how the company policy is. So if you're in a retail, you'll be looking at things such as stock take. If you're working in another environment, you might be looking at quarterly reporting or monthly reporting. So that will be periodic inventory system. It's also aligned to the annual reporting. So weighted average method. Now I want you to see the difference. That the weighted average method takes cognizance of all the prices that have been used when you were purchasing, and you take a weighted average method. So weighted average means your pricing is considered over the number of units that you have purchased. So for example, in this case, this is just the summary of what was the opening. It was cost price was 20, and your sales were also at 20. You had it, then you had 80 as your closing, or as your units that were unsold. You had the purchases of 380,000, and then the next thing that we look at is the next purchases, and up until you get to your closing balance. But if you are looking on the cost price side, you will see that it's not, we do what we call weighting. So what is weighting? Look at the example that is provided. You will pick up that you have to multiply first the units that were unsold with the units that were purchased to get to the values, which is here 1,600 and 7,200. And then you get 8,800 in terms of your value of your purchases, and in terms of your units, it's 380. So when you are weighting, you are going to take this value, divide it by the units as they have done here, and then you get your weighted average cost price per unit, weighted average cost price per unit. So as you move on, you are going to be on the next unsold purchases that you will have to definitely now use the value, which is weighted average value, and then you will have to use the newest amount in terms of your purchases, and then you've got your value, and then you continue on the same way to work on the weighted average method. Now, the comment provided there below tells you that the cost of inventories calculated using the weighted average method differs under perpetual and inventory recording systems as different averages are used. The average may be calculated on a periodic basis or as each additional shipment is received. So in this case, you can see on the example provided, it was applied as each shipment was received. But from the periodic inventory system, so the perpetual inventory system was this calculation here. Perpetual inventory system took cognizance of the sales that were made. So unfortunately, because you were selling, you had to use unsold units to calculate the weight. But in a periodic inventory system, you only consider the purchases. So you'll see you've had a purchase on, you had opening on the 5th of October, you had purchases of 300. On the 25th of October, you had other purchases of 150. This was their cost price. So you say cost price times units. This was total cost price. This was the unit. So you say total cost price divided by the units gives you your weighted average cost. You take your weighted average cost and you multiply it by your closing units, which is 180. After other, so 180 is your unsold units, which is your inventory, and that gives you 4,347. So we're going then to be looking at this question. For those that have not yet completed attendance register, please do so. So in this question, you are told that the following balances were extracted from the records of Sonic Sport for the financial year ended 28 February 2017. I want you to note the year. Additional information, you can see that you do not have the cost of sales value. You do not have inventory at year end. Additional information, Sonic Sport Ltd's inventory consisting of the following: raw materials, work in progress, finished goods, packaging materials. You've got a clear opening balance. Sorry, I just need to quickly share the link of the attendance register. Not sure if anyone has shared it. Just need to quickly share it for those that are coming in. Right. I've already shared the link to the attendance register. I hope it works. So let us go back to the question. So we are provided here raw materials, work in progress, finished good, packaging materials. One can already now pick up that to get our cost of sales, we'll have to do some calculation. One can already pick up that it's not going to be an easy, because now we have to use this methodology. So another methodology for cost of sales, you can be given a balance. You can work with opening, closing, where you've got to work with raw materials, purchases, and work up until you get to finished goods. Similarly with inventory. Then you are told that the following information was extracted from the accounting records for the year ended. Sonia Sport Ltd values raw materials and work in progress according to the first in, first out method. Finished goods and consumables are valued using the weighted average method. Finished production, fixed production overhead costs are allocated at R1.40 based on a normal capacity of 15,000 units that were produced. Raw materials purchases, transport cost, raw materials, variable production overhead costs, fixed production overhead costs, selling expenses. Required, one, you are required to determine the cost of sales figure to be included in the statement of profit or loss, and also the inventory figure to be included in the statement of financial position. So that is basically what we are required to do. So I'm just going to open an Excel. So it's Sonia, Sonic, Sports Ltd. So what we are basically asked, this is the statement of profit or loss and other comprehensive income for the year ended 28 February 2017. So in this case, you would have revenue, cost of sales. You are asked to calculate this balance here. So this is what you are asked to do, to calculate cost of sales. And then you have your statement of financial as at 28 February 2017. Here you've got non-current assets, and then you've got current assets. You are asked to calculate the value of inventory. Of course, here we are going to reference this and say calculation 1. You will have here something that references to the notes to the financial statements. Here it's going to be maybe note, let's say note 2, right. Note 2, yes. So this is the required. And the next step is the calculations. So this is where we do our calculations. And then we reference calculation 1. Calculation 1 will be cost of sales. So in terms of our cost of sales, let us quickly look at the information that we are given. So in terms of cost of sales, what do we need to do? We need to determine the cost of sales figure. So what have we been given? This is what we've been given in terms of the inventories. So we need to work with this structure in order to try now and calculate the amount of balances that are going to go and be used in calculating your cost of sales. So how will we calculate cost of sales? To calculate cost of sales, this is what we are looking for. We are looking for the finished goods amount. This is basically what we are looking for, amongst other things which we will later learn on about. So in order to get there, we have to work with the structure that we have been given. And the structure that we have been given is we have raw materials, we have work in progress, and then we have finished goods. On the other side, we are going to have opening stock. We are going to have plus purchases. We are going to have plus any other costs. Less anything that was transferred to another process or transferred to sales, closing stock. I will also, in doing this, one of the things that we'll also do is we might also look at going back to what your notes say in terms of your study guide on some of the other items. So let us try to work on some calculations now. So for raw materials, remember why we are doing this is, I said to you, we are looking for finished goods. That's what we are looking for, because your cost of sales is determined from the finished goods. So you know it from the finished goods. What is the goods that have been sold? What is their cost price? So that we can be able to determine it from the finished goods. So we need now to take the processes in terms of the manufacturing, where the processes start from raw material and it goes through conversion into work in progress and goes through to finished goods. So this is a cycle that happens in a manufacturing environment. So what is it that we have now on our side? One, we've got opening stock, which in terms of the question, it's given raw materials opening stock, it's 350,000. Then we've got closing. So we've got closing, which is indicated as 250. Next to it, we've got another closing, which is indicated as 225,000. Remember, this is inventory information. So in terms of inventory, we say inventory is measured at lower of cost or net realizable value. So question to you as students, which closing balance now are we going to take for raw materials? Anyone? Please unmute yourself.
The lesser amount.
That's one person saying lesser amount. Another person? Right. The amount that we are going to take, okay, I thought there was someone who was just coming to say something. The amount that we are going to take is 250,000. And I'm going to explain this quickly. We're going to go to your study guide on 4.5.2. Yeah, I think so. 4.5.2 says, if raw material, this is an information presented after net realizable value. So here we are discussing determining net realizable value and recognition at lower of cost and net realizable value. So you are given here the items under raw materials, whether raw materials must also be presented at lower of cost or net realizable value. And it reads as follows. If it will be incorporated in the finished product, and the finished product is expected to sell at more than cost, at more than the original cost, the raw material is not written down below their cost. So what does this say? This says raw materials held for use in the production of inventories is not written down below cost if the finished product in which they will be incorporated is expected to be sold at cost or above cost. So in this particular instance, where do we see what is expected? How is the finished goods expected to be sold? So where would you be able to pick up this information? So we can already pick it up in terms of looking at the finished goods, in terms of looking at the information provided, in terms of this information provided, we can already pick up that there is no information that is presented to us that says finished good is expected to sell at less than cost. There is nothing presented to us. So let's look at example 3.18. Example 3.18. Example 3.18, specific sentence is this one. In this sentence, you are told that due to market competition, raw material can presently be sold for 60 Rand per unit. The net selling price of the finished goods is 1,200 on 31st December 20.11. Above that, you can see here the total cost to manufacture one finished product is 1,500. So one can pick up already here that the finished good is expected to sell at less than the manufacturing value. Now we're going back to here again. So in this particular case, we are not told, I think I'm going too much on many things. So in terms of your study guide, it says, if finished good is expected to sell at less than cost, it should be written down to net realizable value. So in terms of this information given here, you can be able to compare finished product versus manufacturing cost, and you can see the finished good is expected to sell at less than the manufacturing cost, which means that now your raw material can be at net realizable value. But in this case, where we are, we've got nothing, no information that informs us that finished goods is expected to sell at less than cost. So in this case, we expect finished good to sell at cost or above cost. So which means that our net realizable value therefore becomes 250. So we've got an information. So I just want to put all these opening balances, 225 and finished goods 400,000. Work in progress, we apply the same methodology as we did on raw materials. So your closing balance is going to be 275,500. Yes, now let us try to get these figures now here in the middle. So number 3, you are given fixed production overhead cost is allocated at R1.40. Here you are told that raw material purchases were 750,000. So here we've got space to capture the raw material purchases. Transport cost 125,000. Remember what we said? We said inventory is measured, or all costs include costs incurred to bring the asset into its location and condition. Here we've got 125,000. So what we're going to do now, we're going to see how much units did we transfer to the work in progress. So how do you see that? You're gonna say 350 plus 750 plus 125 minus 250. For my science, this is what I'm just going to do. As for science, so which means that we are transferring from raw materials to work in progress 975,000 in terms of the cost of raw materials. So this becomes transfers in, and this is transfers out, right? So here we are putting in 975,000 as coming in from raw materials. Remember, this is a process. Now we're going to go look at the costs that were incurred to convert the raw material into finished goods. So let us go look. We've got here variable production overheads and fixed production overheads. So we're just going to do a quick calculation here at the bottom. So the calculation is just to calculate work in progress, other costs. So we are given variable production overheads. What did I do now? I'm trying to save a bit on time. And then we are given fixed production overheads. Variable cost, it's 1,250,000. Fixed production cost. This is now where we stop. Now we go read back the information. We are given here fixed production cost of 2,250,000. So what is that? That is the cost of fixed production overhead cost. Now this is where things change. In the work in progress, we used the fixed production cost that is allocated at normal capacity. For you to produce at normal capacity, you will use the cost per unit. So we do not use the expenditure. So this is the expenditure incurred. This is what we planned and what is currently held in terms of the policy when it comes to the manufacturing environment. So just want us to read quickly about this for you to be able to understand it. Yeah. Fixed production overheads are not allocated directly to a product with the same ease. So in terms of accounting standard 2, paragraph 13, normal capacity of the production plant is used as the basis for allocation and not the actual production level. So at the bottom of this question, we have the actual, but in terms of what the accounting standards say, it says the normal production capacity of a production plant is used as a basis for allocation. So what does this mean in actual sense is, for this particular case, we are going to use the normal capacity to allocate fixed production overhead costs. So we are going to say 15,000 multiplied by 140,000. 10,000 multiplied by 140,000, which gives you 2,100,000, and therefore your other costs that you are allocating to your work in progress is therefore going to be 3,350,000. Anyone wants me to stop there for them to understand everything that I've said? Are we all following? Right, there seems to be no question. So work in progress is then transferred out and it goes to finished goods. So we've got your finished goods of 4,274,500. Now, you have been told on this question, right, we've dealt with these 1, 2, 3, 4, we've dealt with them. Selling expenses, remember they are excluded. All right, please remember to complete your attendance register. That was just a reminder. Finished goods, we don't seem to have any other costs that are included here. So remember here we were given closings. So on finished goods, we had a closing of 355 cost and net realizable value of 385. Finished goods, straightforward, you use lower between the cost and the net realizable value, and the lower becomes the cost, which is 355,000. Therefore, to be able to calculate how much sales were made, you need to say this plus this minus this. Right. So this becomes this. This is your closing stock. Straightforward, we've got our finished goods. Now we can go and do a cost of sales calculation. Finished goods, remember, here it is 4,301,500 goes under finished goods. So what else do we have? We've got something which is called where we need now to apply. We need to now apply an under recovery or over recovery. So I want us to quickly read on it. So it says here, if the product, okay, it says here, if the production levels are lower than normal capacity, the fixed overhead recovery rate is not adjusted. Allocate based on normal capacity. And the under-recovered portion is charged directly to the statement of profit or loss and other income forming part of the cost of sales expenses. If the production levels are particularly high in a certain period, the fixed overhead recovery rate should be revised to ensure that inventories are not measured above cost. So basically now we need to look at the normal capacity, the production levels, if we have under recovered or we have over recovered in terms of our cost. So how do you do that? Here it is. We're going to do it here. So we've got actual, fixed production, overhead costs, and then you've got fixed production overhead cost, which is at normal capacity. So remember this one, we calculated here. The normal one we have already calculated here as 2.1 million. And then this one actual was actually given in the question as 2,250,000. And one can already see that in this particular question, if you are looking at the question very well, one can already see that we have incurred 2,250,000, whereas at normal capacity we're expecting to incur 2,100,000. So which means that we have to look at the under recovery. So how does sorry, we have over recovered in this question, so I just want us to look at it again. Let's quickly look here. So if the production levels are particularly high in a certain period, like in this particular case, the fixed overhead recovery rate should be revised to ensure that inventories are not measured above cost. If the production levels are lower than normal capacity, fixed overhead rate is not adjusted, and the under-recovered portion is charged directly to the statement of profit or loss and other comprehensive income. So what does this mean? Basically, it means in this particular instance, we have spent more than our normal capacity is, so which means that likelihood is that the production levels have been higher. And then in this particular case, it means that we have to sorry, just a minute. There's something that I'm just doing wrong. I just want to quickly reflect on that. All right, just give me a few minutes. Sorry, I don't know why I thought I was wrong. So this means this 150,000 becomes the under recovery, because remember, we were expecting, sorry about that, we were expecting to make 2,100,000, but we've ended up in carrying more, which is 2,250,000, which means that now, in terms of this principle that I explained here, the under-recovered portion is adjusted, is charged directly to the statement of profit or loss and other comprehensive income, forming part of the cost of sales expenses. So in this particular case, this means that for fixed production cost, you're going to have here something called under recovery. And under recovery, as we have calculated it there, becomes 150,000. And this increases because remember, at production, you only applied what was budgeted, what was expected at normal capacity. Now, in terms of your income, in terms of your statement of profit or loss and other comprehensive income, you are now bringing that cost that you never applied here, which because of the under recovery. Under recovery means at production, you applied 2,100,000 in terms of the standard, which says you can only allocate fixed production overhead cost at normal capacity. So this becomes under recovery of 150,000. Another thing that we see in terms of the question, we've got here packaging materials, which we will use when we're going to deal with, this is not used in the cost of sales calculation, especially the fixed goods. So, but the only thing that we see in terms of this inventory item is the closing balance was 61,500 and the NRV was 60,500. So it means there is a write down because packaging materials at the end of the period will be disclosed at lower of cost or net realizable value. So this means that there will be a inventory written down. So packaging materials, they fall under consumables, written down, and the calculation is going to be 61,500 minus 60,500. So this basically gives you 1,000, and this is the cost of your, then this becomes the cost of your cost of sales. So this is the cost that you take across here, which you were trying to calculate, which is 4,04,070,500. That is the value that we were trying to calculate when we were doing the calculation. So the next one becomes inventory. So here we will have inventory, note 2, which is your inventory. So what is inventory made up of? So this one becomes a bit easy. Inventory is therefore made up of raw materials. Raw materials closing balance 250. It's made up of work in progress. Work in progress was already calculated at 275,500. It's made up of finished goods. Finished goods already calculated 355,000. And then you have your consumables. Consumables, we have already calculated the net realizable value at 60,500. So this becomes your inventory amount that has been made up of this. So your inventory therefore becomes 941,000. So basically, that is where we finish on this question. This is basically what we wanted to do, and then we have been able to do everything. Everyone happy? Right? Remember, this inventory is written down, consumables written down, and then we've got all your totals. Right. So this is solution to self-assessment. Now self-assessment solution. Right. Then we rush to a question 3 that I just want us to do quickly. This is I'm quickly going to close all these things. Just want to open 102, question 3. Yeah, I just want to do this quickly. Question 3. For those that came in, please do remember to complete the attendance. Question 3. Here is the following information taken on the 31st of March 2011 from the accounting records of Apple Ltd, a manufacturing company. And then this question requires you to prepare only the asset section of the statement of financial position, as well as the PPE. Your answer should comply with International Financial Reporting Standard. Comparative figures are not required, policy not required, amounts exclude that, ignore the total column. So what we're going to do in terms of this question, we're going to only focus on the information given to us that is inventory related. So here you are provided information about inventory, 390,000, and then you are told that inventory information is found on no information number 4. So this is all where we are going to focus on in terms of what I want to do with you. So again, this is question 3, part 102. Part 102, question 3. Let's make this bigger. So in this case, I'm saying to you, we're only going to cover the inventory part alone. So I want us to look at the information presented to us. You are told that inventory consisted of the following on 31 December. Cost price. So we've got inventory items. We've got raw materials. We've got work in progress. We've got finished goods, work in progress. And then we are told that here we've got the cost, we've got an NRV, which we will need to calculate. This information is presented into rand. Remember, my goal here, we need to calculate inventory so that we can be able to do statement of financial position. So this is what the required want us to do. I did not even get the company name, but extremely, okay, maybe important. Apple statement of financial position as at 31 December 20.1. You will have your non-current assets. You'll have your note here, and then you would have your rent amount, and then you would have your current assets. So what we want to do is we want to do the inventory portion part. That's all that we want to do today. And that's what we're going to focus on, nothing else, but we're just going to focus on what I want us to focus on, which is inventory. The inventory part only. So here we are given the cost of raw materials under inventory. Raw materials, you've been told that it's 140,000. Work in progress 200,000, finished goods 50,000. Right. Then you are told that at the 20.11 year end, the directors determined that the net realizable value of the inventories were as follows. Raw materials was below cost. Work in progress was also, sorry, only raw materials were below cost. By how much? 5%, which means that it was times 95%. It was 133,000. The work in progress was above cost, so which means that it was multiplied by 105%. The other one was below cost, which means that it was also 95%, which is 47,500. So this is the information that you are given. Nothing else that you are told in terms of this information. So because there is nothing else that you are told, what we are going to be looking at is going to be the information that we are going to be presenting under inventory. So here is the information. So you will note here that the raw materials, we applied a net realizable value, and for finished goods, we apply net realizable value as well. So we go read the information as to what was the reason for us this time around, not considering that principle of if the finished goods are going to sell above or lower than the manufacturing cost. So in this instance, you will pick up here that the finished goods already, as determined by the directors, they determined that the net realizable value of the inventories were as follows. So because finished goods are going to sell at lower than cost, this means already we can also apply the same on raw materials and work in progress. So which means that we must now look at which is now what is the lower of raw materials, or sorry, lower of cost or net realizable value for raw materials. It is net realizable value. Why we are applying that again? It is because with no information given, we can safely make the assumption that, remember, in this case, this is not production. So the other information was applying when it is production of inventories. So in this case, so it is still manufacturing company, but in this case, we know that the finished goods is expected to be sold at lower than cost. So this is what we know. So we take the same thing here. So this means that this is going to be your inventory. Write down, and this becomes an expense that you need to charge against your cost of sales. this gives you a total of inventory written down 9,500. So when we move on now, we can easily pick up inventory. So to disclose inventory would be very easy because now we've already done almost all the work. So which means that we're going to take this balance, and this. Here we're going to take this balance, 133. Here we're going to take lower, and here we're going to take lower. And then this means that your inventory balance is going to be 380,500. Inventory balance, 380,500. So I'm just going to come back here. So what happens on the statement of profit or loss and other comprehensive income? Here we are going to have revenue, and then you're going to have cost of sales. So under cost of sales, as part of cost of sales, you're going to have inventory written down of how much? 9,500. You're going to have inventory written down of how much? 9,500, which you are going to include as part of the cost in terms of cost of sales. Now, if we were to do profit before tax note, so if you are dealing with the notes to the annual financial statement, you will have here, say, note 1, profit before tax, and then you would have your income side where you disclose your income, then you would have your expenses. Under expenses, you would have something saying inventory written down, and then your inventory written down would be the 9,500. Under your expenses, inventory written down of 9,500. So this inventory written down that we found here is also used in order to disclose on items that are after profit before tax. Quickly want to save this one. This is question 3, tutorial 102, solution. All right. Now I just want to quickly check if anyone has got questions on inventory. And please note a feedback form has been shared with you, and it is found on your chart for you to provide feedback for today's class, the evaluation, and make sure that you complete the attendance. So on the work that we have covered basically today, is there anyone who has got questions? Right. If there is no one who has got question, on the next class, we are going to be covering PPE. And for us to be covering PPE, I do want to give you a heads up of what we will be working on so that you come prepared as well on your side. So next week, same time, we are going to be sorry, I see that question, but it's not a question coming to me. So the next time we are going to be working on depreciation, how to calculate depreciation. We are going to be working on depreciation capitalized, how to disclose your PPE. We are going to work on a new term called depreciation, say depreciation capitalized. So I've got a nice summary of what is expected of you in terms of the items that we need to look at. So they've been highlighted by the lecturers as important. So it's definitely looking at depreciation capitalized, how to calculate the PPE note, how to read the information provided and apply it to a question. So those are the things that we are basically going to be covering. So it would really mean a lot for me if I could see how you'll be looking at such issues on your side in terms of the preparations, the questions that you will be bringing as well. But please, we're going to be tackling the presentation in terms of the note of PPE. We're going to be tackling, secondly, the new terminology of depreciation. When is depreciation capitalized and when depreciation is expensed? So on PPE, we're going to look at the calculation of depreciation using different depreciation policies, reducing balance method, as it has been noted that many students struggle on this. We will explain the concept of capitalization of depreciation and how to record it, because this is where also students lose marks. The format of the PPE note on how to draft it. So that's more questions that we'll be focusing on. So we're dealing with one statement at a time. So today we have covered thoroughly the inventory part and also the disclosure thereof, including the cost allocation techniques that are important for you to cover. Any questions for everything that we have covered today? All right, any evaluation in terms of yourself and what was presented today? Where do you find yourself? Are you happy with the progress that you have made? Can students quickly share their struggles around accounting? How do you find yourself at this stage? What is happening? This sharing may be good because unfortunately you cannot even study in groups given the national lockdown limitations. So please quickly share to me how you guys are doing. Anyone? But generally, for those that will be leaving, thank you for attending. I will also currently stop the record to hear how students are doing as we are looking at lockdown. How are you guys preparing? How are you doing? Anyone? We must have someone who wants to share how they are doing. Yes. Anyone? I'm not sure if Kutala wants to say something.
No, I want to say on my side, I will have to watch the recordings again and then practice because I'm not quite clear at the moment.
That's one of the
Thank
advantages.
you for that. Yeah.
Lovely, thank you. That's one of the advantages of these classes. You can reflect back on the recordings. Anyone else, MC Banda? All right, but please note, for any accounting standards that we are going to be covering, it's very important that you understand the theory, that when you meet, you also bring your A game in terms of what you have covered on your side. But for today, thank you very much for attending. We meet again on the 17th of September on Thursday from 4 o'clock. Owen? Yes. Owen, you have the floor. Owen, you had your hands raised up.
Owen's mic is on mute.
Yes, Owen, you are on mute. All right, whilst we're giving him a chance, thank you. Yes, Owen? Owen, you are on mute again.